Hello there. Are you interested in investing or trading but unsure of which path to choose? The decision to become an investor or trader can be a difficult one for some people. So in this video, we reveal the differences and similarities between the two so you can make an informed decision. Spoiler, you should be both. Investing and trading both involve the purchase of financial assets in the hope of earning a return. While they may appear similar on the surface, there are some distinct differences between investing and trading. Trading is when you buy and sell assets with the goal of generating profit in a short period of time. Traders may focus on crypto, stocks, options, commodities, and currencies and other financial instruments with the aim of generating quick profit by taking advantage of short-term market fluctuations. Trading is an active strategy that seeks to capitalize on short-term price movement. Traders often look to play into trends, usually via technical analysis, narratives, or events that may affect the price. A great trader keeps his ammo for when the timing is right, then strikes for moves that have positive expected value, aiming to increase their capital, take profit, then move on to the next trade. An investor, on the other hand, is different on many levels. Investing is when you buy an asset with the goal of holding onto it for an extended period of time, which can be years or even decades, to generate long-term returns. Investors may buy cryptos, stocks, bonds, mutual funds, real estate, and other tangible items with the hope that their value will increase over time. Investors generally analyze potential investments carefully and have a more conservative approach to their investments. Investors prioritize building a solid portfolio of assets they deem likely to return value over time. They often approach their investments via dollar cost averaging, judging sentiment, or fundamental analysis. The key here is an investor's main variable is time. The more time that passes, the more likely that investment will turn a profit. Because of this, you may find that investors feel more comfortable investing into an asset that has been tried and true over the course of a long period of time, as they deem it a safer investment. Time commitment is a key difference between investors and traders. Investing requires less time since you don't have to constantly monitor the market in order to buy or sell investment. You can just set up your portfolio and let it sit for years or even decades, as long as you keep an eye on it periodically. Trading, however, requires a much higher time commitment, since you have to constantly monitor the market and analyze potential opportunities. The amount of risk associated with investing and trading can also vary significantly. Investors typically face longer term, lower risk, while traders usually face greater risk, shorter term. When it comes to risk, investors are more conservative than traders since they are investing for the long term. They are looking for stable businesses and assets they hope will increase in value over time. The goal is to generate consistent and gradual returns, which reduces their risk. Traders, however, are much more aggressive. They are looking to make quick profits from short-term price movements, so they typically take on more risk in order to do so. Lastly, the amount of capital required to engage in either strategy also differs. Investing usually requires capital upfront in order to purchase assets, while trading requires setting aside capital each time you open a position in order to cover any potential losses. Despite the differences between investing and trading, there are a few similarities to take note of. Both require research and careful analysis when deciding which asset to buy or sell. Additionally, both require close monitoring and the ability to adapt quickly to changing market factors. Both require a good understanding of the market, and both need to stay up to date on news and developments in the industry. Both traders and investors can benefit from having an effective trading strategy and a well thought out portfolio diversification plan. You see, investing and trading is similar to an extent, which is why it's so easy to mix up the two and forget which approach you're applying to which asset, where your priorities reside, and what your initial game plan was. The main thing to remember is that traders and investors work based on two entirely different variables. Investors work based on time, while traders work based on price. Therefore, if you ever find yourself closing out an investment because the price is changing, even when your initial thesis is still valid, you may be operating as a trader at that very moment. And we've also seen situations in the crypto market, for instance, where traders come in and attempt to trade a coin and end up as an investor, only doing fundamental research after to justify their investment. Lastly, both investing and trading requires discipline and patience. To be successful in either venture, you need to have a plan and stick to it despite market fluctuations or difficult times. On an important note, I'd like to mention that it is very important to keep the macro circle in mind while investing and know your exit. Because if it's a recession-doomed market, there is no need to have an investment portfolio. And that's why if you've been doing both, you can leverage on the price movement of the market, the price fluctuations of the market to make profits for yourself. Here are some tips on how to approach doing both successfully. Number one, separate your account. Something as simple as separating your investment account from your trading account can go a long way. Things can get very tricky when your capital for both is tied up in the same account, and you can find yourself tempted to go off course in either direction. So separate your account. Number two, sit down and think hard about the approach you want to take as a market participant entirely. How much do you feel you should be dedicated to investing? How much to trading? How are you justifying this decision? Will you rebalance these two every month or bi-monthly or so? Will you be taking trading profits and use them for investment? Number three, limit your ease of assets. In this prime digital era that we are currently in, it's incredibly easy to log into your investment account and make a drastic decision on the drop of a dime. If you find that you have a low emotional control and you often put yourself in bad situations with impulsive decisions, you may find that limiting how quickly you can access those investments or your funds will create a barrier of time for you to fully process your decision before acting irrationally. And number four, this point may sound like regurgitated information to veterans in the market, but the first rule of investing is never invest more than you are willing to lose. This concept should be applied to the market as a whole. If you wholeheartedly can stomach your investments going to zero, you will quickly find that you are able to operate as an investor much more efficiently and could likely turn a profit much higher than if you were to force yourself to be uncomfortably risking much more than you should. Rethink your approach from the ground up. Lastly, on the same note as number four, deeply consider how much capital you are willing to put aside as a trader to sharpen your skills, especially in the early stages of your trading career, where you may pay lots of learning for your tuition fees to the market. How will this capital division impact your ability to perform as an investor? Asking yourself simple questions like this can drastically shift your ability to perform greatly as a market participant. Both investors and traders have their own unique risks and rewards, but in the end, they have one thing in common. They are trying to make money in the market, and each strategy requires different amounts of capital and different strategies for evaluating investment. Though investing or trading the market can be a great way to increase your wealth, the approach you take is critical to your success. And at the end of the day, the strategy that is best for you will depend on your goals, your risk tolerance, and financial situation. I hope you find this video informative and refreshing. Thank you for watching. Please remember to like this video and subscribe to this channel. Oh yes, that will be all for today. And until next time,